Hey guys, it's Nick, and in this video, I want to talk about the effect of inflation on the housing market. And specifically, will the higher rates that are coming crash the housing market? I'm going to take a look at what higher rates do to the affordability of houses at different interest rates. Also, I'm going to talk about the little known clause in mortgages that banks use during times of high interest rates. So right now, the inflation rate is about 7.9%, which is the highest it has been since 1982. And today, the Fed raised the Fed funds target rate by a whopping 1/4 percentage point, which means that with the current 0.5% Fed funds rate, we have a negative 7.4% real interest rate. To put that in another way, any money you have in the bank is losing 7.4% a year. The Fed also say that they expect to raise rates 6 more times in 2022. Now, they may be saying this now, but you can be sure that they will look for any excuse, whether it is the war in Ukraine or a weakening economy, to actually ease rates more if they can get away with it. If they actually raise the rates to the level that they needed to be to slow down inflation, it will surely cause a recession or even worse. So let's see where mortgage rates were back in the 1980s when inflation was at the levels we have now. And then let's see how much house you can buy at those higher mortgage rates. So let's start by looking at this historical chart of the Fed funds interest rate since 1970 versus monthly inflation on a year by year percentage change. So back in the 1980s, early 80s, late 70s, the inflation rate went up to about 15%. And to stop runaway inflation, Paul Volcker supposedly broke the back of inflation by raising the Fed funds rate to almost 20% over here. So you see, as the green line inflation rises, the Fed funds rate has to rise also to try to tamp it down. And they did that successfully in the early 70s, and then it raised its head again. And then they really had to go all out and really try to kill it. And they were able to do that here, but it took almost 20% interest rates to do that. So where are we now? This is probably not showing 2022, but it shows inflation about 5%, but it's really around here, like 8%. And yet the Fed funds rate is down here. So by looking at this chart, you see that the yellow line needs to follow the green line, and we are nowhere near that. So for inflation not to get out of hand, the Fed funds interest rate has to be way higher than the 0.5% it's now. So the Fed funds rates should be somewhere in the neighborhood of 5 to 10% around that area. So let's see where 30-year mortgage rates are when inflation is at 8% and the Fed funds rates is somewhere between 5 and 10%. So here we see back in 1982 when the inflation rate was about 8%. The 30-year mortgage rate was about 16%. And before that, a few years before that, during the Arab oil embargo, the inflation rate also went above 8%, and the 30-year mortgage was somewhere around 8, 9, 10%. But this last spike up was when they really tried to break the back of inflation, so to speak. So the 30-year mortgage rate could be anywhere from 8, 9 to 16% when you're having 8% inflation in the US. So let's see how much house the average household can buy at the current interest rates. So this article says that median home sales prices are $374, an increase of $50,000 from just a year ago. This article is from 2021. And mortgage rates fell significantly in 2020, driving up demand. So if mortgage rates fall and they drive up demand, what happens when mortgage rates rise? They kill demand, right? So average home price in the US is about $375. Zillow says the typical home price is $293. and that the US median income is about 65,000. Now, the St. Louis Fed said that the real median household income in the US in 2020 was 67,521. So let's see how much house you can buy if you're the average couple with the income of 67,500. So here on this Zillow Affordability Calculator, I put in 67,500, no debts, zero down payment, just so you can see how much actual house you can buy with your income, and a debt to income ratio of about 30%, which most people recommend something like 28% or something along those lines. So let's leave it at 30, and the 30-year interest rate of 4%. So that affords you a house of about $301,000 with a monthly payment of about $1,441. Now, as you know, most people shop not on the price, but on the monthly payment. That's how people buy cars. That's how people buy houses. How much will it cost me per month? And as inflation goes up, companies may raise their prices of their products quickly, but they are slow to raise people's salaries as quick. So if inflation rises pretty quickly, people's average income may not rise as quickly. So what happens if your annual income stays the same, but the interest rate that you pay for your mortgage goes up? Let's see how much house you can afford. So if the 30-year interest rate goes up to just 6%, then the house you can afford goes down to $247,000, and there's that monthly payment, $1,485 a month, about the same as the $300,000 at 4%. At 8%, you could only afford $206,000. At 10%, $175,000, and at the Paul Volcker inflation-breaking interest rate of 16% for a 30-year mortgage, you can only afford a $118,000 house. And if you think a 16% mortgage is unthinkable, just take a look at Argentina. They set to raise their key rate to 42.5% on Thursday, with annual inflation running at 51%. So let's just see what would happen if we had Argentina type inflation and a 42.5% 30-year mortgage. Oh, you can buy a $46,000 house. So what does this mean? Are we going to have 16% 30-year mortgages in the next year, or God forbid, Argentina like 42% interest rates? No, it's not coming. Anything's coming that quick, I don't think. But it gives you something to think about, that when the affordability of these houses go down because of higher interest rates and people aren't making more money, then if there's nobody to afford a house at $300,000 when interest rates are 6% or 8%, then the price of the houses have to come down to meet the level where people could actually afford it. So like in that example, if they can afford about $1,500 a month at a 4% interest rate, that gets them a $300,000 house. At a 6% interest rate, maybe $250,000. At a 8% interest rate, maybe $200,000 house. So what that means is that potentially that house that is $300,000 now, if interest rates go up to 6 or 8% on the 30-year mortgage, that house can drop to $250,000 or $200,000. That's what that means. Now, about that little known clause in your mortgage, it's called the acceleration clause. And this clause allows the banks to demand full payment of the whole loan immediately under such circumstances like filing bankruptcy, cancellation of homeowners insurance, and even a single missed payment. So why is this a big deal? Well, it's not a big deal when rates are low. When rates are low, banks would rather you just keep paying your mortgage. And even if you missed a payment or two, they would rather work with you to get you back on track than invoke the acceleration clause and start a foreclosure. However, if interest rates went up to 7 or 8% or even higher, banks obviously would rather be making new mortgages at these much higher rates than these low 3 or 4% mortgages that they already have on their books. So all of a sudden, there is a huge incentive for the banks to enforce the acceleration clause for even one missed payment. If they can foreclose, sell the house, and put the money back out in new mortgages at much higher rates, then that is what they will do if they can. And so this is what happened in the late 70s and early 80s when the 30-year mortgage rates went to 16%. Banks were trying to get their lower interest rate mortgages off their books in favor of new loans at much higher rates. Now, a lot can happen before we ever get to those kinds of interest rates, but don't assume because you have not seen something like this in your lifetime that it cannot happen. There will be a lot of uncertainty of how our huge debt and world events affect inflation and our economy. So be diversified because events don't usually play out the way most of us expect them to. I hope you liked this video and I'll see you in the next one. Thanks for watching, guys.